Maintenance of capital accounts of partners. Now students, the capital accounts of the partners can be maintained in two different ways. The first of them is called as fluctuating capital accounts. Fluctuating capital accounts. Now students, as the name suggests, fluctuating means in which the balance of the capital keeps on varying. In this process or in this method, only one capital account or one account relating to a partner is prepared, and all the adjustments relating to interest on capital, salary, profits, drawings, etc. is passed through this particular account. That is, all the adjustments which actually take place in the capitals of the partners are passed through this particular account only. Now, since all the adjustments are made, so usually you will find that the capital balance keeps on fluctuating. Hence the name, that is fluctuating capital accounts. Now, the format of this account appears as again the basic format is same, that is the debit side and the credit side. This is capital accounts. Obviously the name of the partner would be mentioned here. We have particulars here, amount here, particulars here and amount here. The opening balance would be by balance brought down. Since capital represents a liability for the firm, therefore credit balance. Everything that the partner receives during the year or that is credited to his account will be transferred on the credit side as by interest on capital, by salary, by commission, by profit, and so on. On debit side, we will have drawings to interest on drawings, any loss that is there which is to be shared by him would be shown on the debit side. Finally, totaling out, we will get to balance carried down. This is closing balance. That means all the entries which a partner is entitled to or all the amounts which he is entitled to are posted on the credit side. Whatever he withdraws during the year is posted on the debit side, and you can find out the closing balance. Since all these entries are put in the capital account, the balance keeps on fluctuating. That is, the opening and the closing might be different. Hence, it is called as fluctuating capital account. Coming to the second method of preparing capital accounts. The second method is different from fluctuating method. It is called as fixed capital method. Fixed capital accounts. Now students, it is called as fixed capital account. So why fixed? Because in this usually the opening and the closing balances remain fixed. In this case, two accounts are prepared. The first one is called as partners capital account and the second one is called as partners current account. Now students, the format for these accounts remain same as debit and credit sides, but as the name suggests, all the entries relating to capital itself per se are put in fixed account or capital account, and other entries which affect capital during the year like profit, interest, drawings, they are passed through current accounts. That is, the opening and the closing balance of the capital accounts remain same. They are affected only by specific items. That is, whenever a permanent capital is introduced during the year or withdrawn during the year. Only in this case the capital accounts would be affected. Otherwise, all the other entries, the entries which are regular in nature like profit, interest, commission, they will be passed through current accounts. So what we'll have is the format will show by balance brought down, that is opening balance, and usually this is the closing balance, balance carried down. In this case, only two entries whenever there is a permanent addition of capital, that is by cash, additional capital, it is shown here, or in case there is withdrawal or drawings, we should mention it as withdrawal of capital, not drawings. Drawings usually refer to a regular nature. So withdrawal of capital. That should close your capital account. This is the end of it. Usually in this case, because additional capital and withdrawal of capital are very far and few entries, so usually the opening and the closing balance remains same. Hence it is called as fixed capital account. What about current accounts? In current account, if in case any balance is there, that is balance of current account, we'll pull it as closing by balance brought down, opening balance. Then all the entries which would otherwise have been part of capital would now be passed into current account. That would include by interest on capital, by salary, by commission, by profit. There can be drawings to interest on drawings. There can be loss also. So once all the entries have been put, you can balance it out and calculate to balance carried down, that is closing balance.